Are gold and crypto investments or hedges? And why does that distinction matter? Hi, I'm John Ameriks. Today I'll unpack how investors think about gold and crypto and why the investment versus hedge debate is so important and what it means for portfolio construction. The case for including gold or crypto typically starts with diversification. These assets don't drive their value from corporate earnings or traditional cash flows, and at times they behave differently from stocks and bonds. For some investors, that difference is exactly the point. Gold has a long history as a store of value and is often viewed as protection against inflation, currency debasement, or geopolitical stress. Cryptocurrencies, particularly Bitcoin, are sometimes framed as a modern analog, scarce, decentralized, independent of traditional financial systems. That said, there are also very good reasons advisors may choose not to include them. Neither gold nor crypto generates income or cash flows, which makes valuation difficult, and long-term expected returns are much harder to anchor. Crypto, in particular, introduces lots of additional complexity, high volatility, evolving regulation, and changing market structure. Even gold, despite its long history, can experience extended periods of underperformance. For advisors, the decision often comes down to client objectives, risk tolerance, and beliefs. These assets may have a role for some portfolios, but they're not necessary for disciplined long-term investing. Well, an investment is typically something you expect to generate long-term returns through cash flows, growth, or productivity. A hedge, by contrast, is something you hold because you hope it behaves differently when other parts of the portfolio are under stress. Gold is most often framed as a hedge against inflation, currency risk, or geopolitical uncertainty or stress. Crypto is sometimes framed similarly, though with much shorter history and far less consistency across market cycles. Why this distinction matters is expectation management. If you treat gold or crypto as a long-term return engine, you may be disappointed. If you treat them as hedges, you may have to accept that they may underperform for long stretches when the hedge isn't needed. Clients need to understand clearly that these are imperfect, risky hedges, not some form of insurance. For some clients, it may be far better to talk about such assets as potential diversification. This avoids the chance someone will over-rely on the expectation of a payoff that's not guaranteed. Advisors add value by being explicit about what role these assets play and how success should be measured, and what trade-offs clients should expect along the way. Well, Bitcoin was primarily designed as a store of value. Its supply is fixed, its use case is relatively narrow, and its appeal largely rests on scarcity, decentralization, and adoption as a monetary or reserve-like asset. Ethereum, by contrast, functions more as a technology platform. It supports smart contracts and decentralized applications, and its value is more closely tied to its usage, innovation on the platform, and the growth of its ecosystem. That distinction matters because the drivers of risk and return may be different. Bitcoin's thesis depends on continued acceptance as a store of value. Ethereum's depends on technological relevance, developer adoption, competitive dynamics, and regulatory changes. For advisors, the takeaway is that crypto isn't a single exposure. Different assets within the space behave differently and should be evaluated on their own merits. Gold has at times held up better than risk assets during stress environments, particularly those involving inflation shocks or geopolitical uncertainty. That history is why it's often viewed as a defensive asset. Crypto proponents make a similar argument, suggesting that cryptocurrencies are independent of traditional financial systems. In practice, however, crypto's often behaved like a high-risk asset, declining alongside equities during sharp market sell-offs. That doesn't mean gold or crypto never provide diversification benefits, but it does mean their hedging properties are conditional and not reliable across all types of stress. For advisors, the key is realism. These assets may help in some scenarios, but they shouldn't be relied on as universal protection. Clear expectations matter more than compelling narratives. Be sure to like this video and subscribe to this channel to hear more from Vanguard's thought leaders.